Yeah, hi Tudor, that's great. Okay, that's super. I think I've got everything set up there as well. Just got one extra screen today, so that's why it's taking me a little bit longer, but I think we're there. Great, well, let's get going. A very good afternoon or good morning to you, depending where you're listening from. Really looking forward. That's great. I think I've got it. That's it. There we go. Really looking forward to this session. Got a lot of action, so it's nice to have a little bit of movement in the currency markets today. So I'm going to start by looking at our dominant sentiment. Now, our dominant sentiment pair for the day is the euro pound. Now, just taking a look at the pair, we've seen some downside in the euro pound, and this is for the following reasons. First of all, we've had a negative ruling from the German Constitutional Court, which basically gave the ECB 3 months to show that its quantitative easing program was proportionate. We've also had a rate decision from the Bank of England, and the Bank of England kept interest rates on hold, and they've postponed the further quantitative easing, which some market participants were expecting the Bank of England to announce. They were expecting extra quantitative easing, but they've kept that on hold. There were 2 dissenters, Haskell and Saunders, so it was a 7-2 split. However, not only did they keep interest rates on hold, not add additional quantitative easing, but they also projected a rate hike and a return to 2% inflation by 2022. So that's been positive for the pound on the day. So it made sense to pair the euro and the pound together. Now, at the time of the announcement, we didn't want to be selling the euro pound towards the lows. So we're looking at this region to sell, and we're looking at this area to take profit just above the 0.8700 handle. So if you're not already short here, you can still trade a return back up to this level, looking for a move back down to this 0.8700 handle. So that's probably the best the dominant currency sentiment pair to trade. However, it's also worth pointing out a few other currency pairs to trade, because we have had a strong risk-on tone coming into the market. So if we just go over what we're seeing upside in European equities. We've been seeing some upside in bond yields, a little bit in the US bond yields. So that's been supportive for risk. On top of the rising equity prices and rising bond yields, we've also, looking at commodities, we've seen WTI moving to the ADR highs of the day and Brent crude. Alongside oil moves up, we've seen copper prices moving up. Platinum's a little still range bound, and we've seen upside in gold, which you would expect with the kind of risk on tone. That's the way we've been seeing gold moving recently. When it's risk off, gold is selling. When it's risk on, gold is being bought. Looking at the futures markets, the S&P 500 Dow futures moving to the upside as well. Nikkei moving to the upside above the ADR highs of the day. Volatility moving down. So these are all clear signs that we're in a risk on market. Then we're not surprised when we go to the currency block. We're seeing strength across the commodity currencies, Aussie, CAD, New Zealand dollar, all showing a broad strength on the day, and weakness in the Swiss franc, the Japanese yen. And as the dollar has been acting as a safe haven, we'd expect to see some dollar weakness. And we're seeing a little bit of dollar weakness, but a more range-bound action in the dollar. But generally speaking, we're seeing those risk-off tones. So as a result, we went through a few other pairs that we can consider for buying. So the Aussie US dollar, any return back to that 6.425 region is opportunities for buying. The New Zealand US dollar, any return to that 6.034 region, that can be considered opportunities for buying. Also, looking at some of the yen crosses, the New Zealand Japanese yen, 64.12 can be considered opportunity for buying, and the Aussie yen, 68.40, just at the top and breaking out of that ADR range, can be considered suitable for buyers as well. So quite a range of different currencies that we could be looking at today. But as I said, our dominant currency sentiment pair today is the euro pound, with 2 bits of contrasting news. So that's the dominant currency sentiment pair to look out for. Other key things to note, a couple of things with the Australian dollar, just to be aware of. The Australian dollar had a very strong trade balance surplus that was exceeding the expectation. So it was a $10 billion surplus. The maximum expectations had been for $9 billion, the lowest $4 billion, but that boost of $10 billion far exceeds the expected figure, and that has been very supportive for the Australian dollar during the session. So this has meant that the estimates for the first quarter have now risen from minus 1.2% to minus 0.5%. So that's been a good boost for the Australian dollar. We've been seeing that through the session. As Arnold pointed out, one thing to look at the details of that trade balance is it was mainly mineral driven. So that was expected from renewed demand for minerals as China gets back online. But the service sector saw a decline. So it wasn't all roses, just to keep that in a little bit of perspective. And then we had the stronger export data from China. That has been supportive for risk as well. So we had that good data from Australia, good export data from China, and then just something that was easy to overlook but is helpful and has been very helpful for risk today has been this telephone call between the US and China trade chiefs. They're said to be planning a phone conversation as soon as next week on progress in implementing the trade deal. So we've got China's Vice Premier Liu He and Lighthizer partaking from the US side. So that is very supportive for risk, because one of the concerns has been that Donald Trump is, wanting to renew tariffs on China and an escalation of that US-China trade war, which we've seen throughout 2019. So that's been supportive for risk, because at least it's showing the two sides are looking at talking. That is potentially supportive. But remember, just like 2019, unfortunately, we're going to be most likely to be seeing President Trump, issuing tariffs on Monday and then willing to do a trade deal on Tuesday. So expect much more of this flip-flopping kind of actions. It's characteristics of the US president. He likes to sort of rattle his opponents and then do a deal. We saw it with the USMCA, with Mexico and Canada, that trade deal. We saw it before with the US-China trade, first trade deal. So we expect his mannerisms to carry on. But this, for now, for this session, is being positive. But remember, that could change at any moment. So although we're seeing the risk on sentiment remain, we are seeing, as well as the goods, we are seeing the potential for risk off to turn. So if President Trump could have a conflict with China, remember US Secretary of State Pompeo was saying some negative things about the origin of the virus coming from China. And we also had jobless claims going up above 9 million today. So just take a little look at the US initial jobless claims coming up. Now that is due out later, and this is another risk event that we have for today. 4 million jobs expected in the, oh sorry, no, hang on, getting the wrong day. There we go, that's tomorrow. Here we go, sorry. So 19.9, that's better, 19.90 million jobless, sorry, I'll get there eventually. There we go, initial jobless claims. So 3 million, apologies, initial jobless claims expected. Now, the key thing to look for the initial jobless claims is look within the minimum and maximum numbers. If we get more than 9 million jobless claims expected, then that could potentially change the market to a risk-off tone. So a lot of this bad data has already been priced in, and the market's looking forward ahead to the non-farm payroll data tomorrow. But still, we just need to be aware that if we did get a larger than expected figure, that could still impact risk. So do keep an eye on the initial jobless claims data out 1 30. So that's out in a couple of hours, and that could skew risk alongside any announcements of President Trump, more conflict with China, the re-emergence of that US-China trade war. That's something that's a possibility. So with that being said, that is our bias for the session. We've looked at a number of different currency pairs. Looking ahead, we've seen that the initial jobless claims is the major scheduled event which we could change risk. Just had an announcement on the feed looking to bank some pips possibly on the euro pound. So make sure you just take a look at that with the euro pound moving down. You can see obviously this this key support level just on this 0.8700 region is offering a good area to bank some pips. So just check out the latest video so that you get exactly our latest position on the euro pound. Just saw that coming on to the feed while I've been doing the webinar. So that's bang up to date. So make sure you get that and don't miss that video, particularly if you're short euro pound. Okay, folks, so that's what we're looking at today. That's some of the major events. If you could put down any trade ideas that you have. Remember, this is your time for me to review trades, have a look, anything that you want to mention, maybe any trades you want to share, even any things that you've learned. This is a good time to share it in the question and answer panel and in the comment section. So I'm just going to go through the Q&A section now. Starting with you, Tudor. Hello, good afternoon, Tudor. So all of these central banks talk that they have so many tools at their disposal, but they're nearly at zero interest rates. Of course, some of the central banks are below zero. Yeah, cutting interest rates is the only real proven tool, and the rest of the tools are experiments. Yeah, like quantitative easing. Yes, Tudor, I see where you're going here. Yesterday, before the Asia market opened, Trump said, okay, first of all, I want to take that first point because it reminds me of something that's very helpful, and it's particularly with regards to gold. Now, let me point something out. So first of all, looking at gold charts, looking at the gold chart, let's just look at this. Now, we can see this big upside in gold, and as a number of you are aware, I've been saying that if you look back to 2008, 2009, you can see that when volatility spiked higher, okay, gold tends to move down and sideways. It's only as volatility goes lower that we tend to see gold prices moving higher. So in this 2008-2009 crisis, we're seeing a very similar action. When the volatility spiked higher, gold prices move lower. Now, the outlook for gold is still very bullish. Now, the reason for gold's bullish outlook is twofold. First of all, and this picks up on your point, Tudor, interest rates are extremely low. So just go to our currency research section, and you'll see that interest rates are these very low levels. Look here, Fed 0.125%, ECB negative interest rates, Bank of Japan negative, Canada, Aussie, New Zealand, all on 0.25%, and Swiss National Bank negative. So let me point out to you how this results in negative real interest rates. So you've got the Bank of England, interest rate is 0.10%. But notice that the projected inflation level for 2021 was 2%. So that means if inflation is at 2%, and the current interest rate is 0.10%, that means a real negative interest rate of minus 1.90%. So it means when you put your money in the bank, you can expect it to lose value by nearly 2% a year. So cash is losing value. Now, obviously for an investor, that's not what you want. You want your money to gain value, you don't want it to lose value. So this means having your money in cash becomes unattractive. So you're looking at other places of value. Now, one of those places is gold. Now, with equity markets being so pressured, you know, people aren't necessarily wanting to take the risk, are they, with Are the second quarter earnings going to be really bad? How are future companies going to manage the change that COVID-19 has brought about? Whereas gold, although it doesn't offer a yield, so you don't get paid interest for holding gold, and in some cases, if you hold physical gold, you have to pay a storage fee. However, in times of crisis, once we see the main crisis kind of scale back, and we see that volatility moving down, then gold is set to move higher. Now, not only do we have negative real interest rates, which makes gold more interesting, we also have money itself being devalued through quantitative easing. The quantitative easing program just devalues currency, so currency becomes less valuable. So all of this points strongly to higher gold prices going forward. So that's just something that's worth mentioning. And also, we had the highest inflow in gold exchange traded funds, in the first quarter of 2020, according to the World Gold Council. So basically, I've been sharing this on my forexlive.com blog. You can go and have a look at it. But basically, what you see is that when jewelry holdings of gold have decreased in the first quarter of 2020, which is what you'd expect because no one can go out to buy any jewelry. So you'd expect that to decrease. But exchange traded funds of gold have really increased. And that has led to an uptick in overall demand in gold. But once people start to move again, and you get that normal recovery in jewelry demand, then expect gold demand to be much, much higher. So Tudor, going back to what you're saying, one of the upsides for central banks cutting interest rates all around the world is that it does make gold potentially more valuable. So longer term, medium term gold positions make sense. Now, the thing that can skew the pitch here is if we suddenly see heavier equity selling. If we suddenly see heavy equity selling, then we're likely to be seeing gold move down. But at the moment, we can see quite a nice technical triangle forming here. So if you just taking a look technically, you can just see do a very simple triangle. And typically when you get this kind of coiling action, when you get price coiling, ranges getting narrower and narrower, that is often before a major breakout. So potentially you could look here to see, if volatility keeps going down, risk on markets keep improving, they would expect this to break out of this level and move higher. Or if equity markets start falling, then we expect break of this level. And of course, look for a false break of that level as well. That's also a possibility. But Tudor, I just wanted to share that with you about gold. It's a helpful little thing to be aware of, and particularly with the fundamentals for gold are very strong at the moment. And if the market stays the same, these interest rates, Tudor, are expected to remain low for potentially years. So the outlook for gold does look potentially very good. Yeah. Okay, next question. Yesterday, before the Asian market opened, Trump said that China may or may not keep the trade deal, adding that he will be able to report on whether or not China is abiding phase one trade deal in 1 week or 2 weeks. Yeah, I saw that comment. I expected the Australian dollar pairs to tank because what Trump basically said was that the whole trade deal could fall. Of course, the market barely reacted, and today we have news that USA and China are talking regarding to trading, and it shoots up. Yeah, Tudor, I really have sympathy there. That was really frustrating. I saw that as well, and I shorted some Australian dollar pairs for exactly the same reason. And then, there was barely a reaction to the market. So sometimes that just happens, and then you've got it, completely denied the next day with USA and China talking regarding the trade deal, and the Aussie shoots up. Plus, you have that really good trade data out overnight. That just happens from time to time, Tudor. The key thing, when that happens, the key thing is that don't keep holding on despite yourself, if you know what I mean. So, say you were short the Aussie US dollar from last night, okay? And, you shorted around down here, 0.6390. And then you come to the morning session and, the prices, moved against you, and you start to see that that there's fundamental news against you, well, that's the time just to close the trade, especially Tudor, if it's an intraday, it's intraday trading. It's not a position, you're not holding for a longer time, you're not willing to ride out some of these ebbs and flows. In that case, the key learning point is don't hold on. So that's the key. So just to cut those short, that's like a part of the way of using that dynamic stop loss. I know. I feel for you on that, Tudor, because I got sucked into that as well, and I was expecting more of a reaction. So don't be too hard on yourself about that, Tudor, although it's very frustrating. Richard, hi. Do you think US unemployment claims could turn the market back to risk off? Markets seem to be used to the figures now, so long as figure doesn't deviate from the estimates too much. Yeah, Richard, that's exactly that's exactly my thoughts. 3 million expected, 9 on the upper band, 1.5 million on the lower band. The market is well used to these claims, expecting them to be poor. It's just worth bearing in mind, when it comes to it, nothing's particularly expected. I'd expect this to be a non-event. If we did get anything above that 9 million, it could turn that market risk off. So it's more something to be aware of than necessarily I'm expecting. I'm seeing it exactly the same way that you are, Richard. Okay, read the article on Forex Source saying that the US dollar unemployment claims could be tradable if it goes above or below minimum max expectations. The article saying that the US dollar will react positive if the number is below minimum, basically will act as a safe haven. But I remember when the USA announced that they had 20 million unemployed and the US dollar sold off against all other currencies. Yeah. So if the unemployment claims is better than expected and it's better than the minimum expectations, in other words, the picture is rosier than we expect, then you would expect to see the US dollar selling off. So we've got the US dollar acting as that safe haven at the moment. Now, the general playbook is equity market selling, dollar buying. So if anything's supportive to the equity market, then I'd expect that to be negative for the US dollar. That's the way that I'm reading this at the moment. Now, obviously, you've got to look at the event and just see the reaction at the end, but that's the expectation I would be expecting for the US dollar to keep acting as a safe haven. Now, eventually, it'll stop acting as a safe haven, but I don't think we're there yet, Tudor. We're still in that very risk-sensitive market, and the US dollar, most liquid currency, it's still going to be the most popular. So, yeah. So I think you and I are seeing it the same way, Tudor. Rolando, why does Aramco rising price to Asia market seen as a positive for oil? Thanks, Rolando. Okay. Yeah, no, I did see that briefly on the headline, and my short answer, Rolando, sorry about this, is I'm not entirely sure. I saw the headline, but I can't remember. Yeah, here it is. Saudi Aramco raises June Arab Light official selling prices to Asia by US dollar 1.40 to US dollar 5.90 versus Oman Dubai average. I guess my guess, Rolando, is that this is an indication of sort of more optimism in the oil market, the fact that selling prices are rising. So it's indicating that as prices are going up, that's as anticipated as demand increases. You can only sort of charge higher prices as demand rises. So my guess would be that Saudi Aramco are sort of looking through the COVID-19 lockdowns, and they're starting to say the worst is behind them. So I think that's why that's going to be seen as a positive for oil. The thing to be aware of with oil is that even after the lockdowns end, there is still a lot of surplus and reserves in oil. So just to be aware that it should be some time before those oil markets recover. And remember, if you are trading oil, look out for that rollover contract that can be really punitive, and a number of different brokers reserve the right to change the contract at any point. So just to be aware of that. And I personally think that actually maybe like a longer term share position is a better way to benefit from the cheap oil prices at the moment. Okay, Nilanka, yeah, let's have a little look at the pound CAD currency pair. Yeah, okay. All right, we'll just make a note of that, and I'll come back to that in a minute. So pound CAD. Okay, so the thing about the pound CAD, Lanka, is that we have strength for the pound and the Canadian dollar. So with oil prices moving higher, that's supportive of CAD. And then with the Bank of England decision, that's been supportive of the pound, with the quantitative easing being postponed and rate hike being projected for 2021 and return to 2% inflation. So that is strength for both the pound and the CAD. So what we'd want here in this scenario is if we suddenly saw oil prices really fall, that would result in CAD weakness. So that would be a sentiment shift. So sudden falling oil prices would be supportive of pound CAD. And this would be like a good supportive region. This area here, if we did get a tradable sentiment shift, would be a good area for longs, because you've got the ADR low here, and you've got that big round number, the 1.7400 handle, and you've got a demand level as well as this strong support level. So that would be the sentiment shift. It would either be something very negative for CAD, most likely a drop in oil prices, or anything very positive for the pound, maybe like the EU-UK trade deal. But you'd also want to see weakness in the Canadian dollar. So the fact that these are both reasons for strength today means you'd expect more of a range bound reaction in the pound CAD. So that's my take on the pound CAD pair. I hope that helps. Yeah, okay, that's good. Rolando, do you think risk may turn negative ahead of tomorrow's NFP given the current sentiment? Yeah, risk keeps flip-flopping, Rolando. So the thing that makes me nervous is it's Donald Trump and the constant changing. We don't like China. China started the virus. We're going to put tariffs on China, and then, as you say, Rolando, the next day, well, we're going to do a deal with China. So yeah, I think that risk tone is sensitive at the moment. So it's being really on top of the news feed, having your squawk on, and just looking for that US-China trade rhetoric. That's the main risk that I see as one of the jobless claims. So that the two things for risk that are the most likely to move risk is President Trump and Secretary of State Pompeo, and the jobless claims out in about an hour and a half. So they're the two areas I'm looking at, Rolando. Yeah, Horatio. So the current risk sentiment is risk on, but the overall outlook remains bleak, correct? Yeah, Horatio, I'd say that's a pretty good way of putting it. So when this is the case, when the overall outlook is negative, the short-term sentiment's positive and vice versa, we can look at an opportunity to enter at better levels, as well as hold trades we have on that match the overall sentiment. Or is there a better way to trade? Yeah, Horatio, for like a longer term position trade, there's nothing that's so optimistic that it's changed this negative sentiment. We still have second quarter earnings to come. There's expectations that those earnings aren't going to necessarily be very good. We still have concerns about, you know, future earnings of companies and multiple levels of calculations for shares. How close are they to fair value? That's on the one hand. On the other side of the argument, Horatio, is that with all the stimulus, all the quantitative easing, all the central bank, all the fiscal stimulus from governments rather, is supportive of the markets. So it's a tricky one to call. It's a very mixed market. But I think you put it the right way. The current risk sentiment is risk on, but the overall outlook remains bleak, correct? Well, it sort of depends a little bit, because I'm thinking about the Australian dollar with that very good trade balance data. That's been supportive for the Australian dollar today. We see that strength. But okay, let's look at the Aussie Yen, a good risk pair. That's a good, we can see, okay, we still got this heavy bleak outlook. So from a wider, longer term, situation, we still haven't returned to that. We still haven't returned to that 71 handle, that key overhead support there. So that key level is still in play. So you can't really say that we've recovered out of risk sentiment until you see at least a breach of that 71 level. That would be an indication that you're there. Actually, still being below that level does give us an indication that when things aren't as well recovered as we'd like. The difficulty with this current crisis, Horatio, is the fact that it's a medical problem. And because it's a medical problem, a medical solution could potentially change it very quickly. So if there was news of a vaccine that was going to be in circulation before Christmas, before the winter time, then you'd expect that to be very, very positive for risk. I would agree that the overall outlook still remains bleak, and I would agree with your assessment on that for sure. Okay, Yanko, pound yen long. Any thoughts? Yeah, a pound yen long makes sense. Yanko, we've got reasons for pound strength because of the Bank of England decision, and the risk on sentiment means that we have reasons for Japanese yen weakness. Yes. Now, the only issue here is where to get in on that kind of trade. So, the broad trend is down. So remembering the big picture here is that EU-UK trade deal still to be announced. There's expectations that the Bank of England will still have to raise quantitative easing because their QE program is due to run out in July. So at some point they have to increase the quantitative easing amount. So medium term, the outlook is still negative for the pound. And obviously the yen being a risk currency, that as soon as there's one negative headline about US and China, we'll see Japanese yen strength. But in the short-term sentiment, given what's happening today, we would expect buyers on any retracements. So, for me, I'd be looking at a retracement down to that 131 handle. So any retracement back down here, 131, I'd expect to find buyers on pullbacks there. So that's how I'd look at that. But the thing to be aware of, what would change the outlook is if there was a very negative announcement on the US-China trade announcement, or even something negative coming from the initial jobless claims. That's what I'd be looking at there with the pound yen, Yanko. I wouldn't want him to be getting anywhere near these highs, and I wouldn't even want a pullback to the 50%. I'd be looking for a deep pullback on that pair, just given the fact that the outlook is, the longer term outlook is not great. Okay, Richard, got stopped out of euro, Aussie dollar, 1.68. Let's have a look. Euro, Aussie dollar. Got stopped out last night at 1.68. What would be a good entry. I currently have an order at 1.6800. Oh, 1.69. So, oh, that's annoying. Yeah, just got teaked out there. Currently have an order at 1.6800. Yeah, good re-ent. So let's just go over it quickly. There's reasons for euro weakness because of the German Constitutional Court decision, and there's reason for Australian dollar strength because of the excellent trade balance data and the risk-on tones that are coming into market. So Richard, yeah, euro Aussie dollar shorts make sense. Now, a good re-entry level, just looking here, see where we've got. See, I think that would still be a little bit too low for me. I think this short-term support level here, this minor support level here, just we can see a little bit of consolidation, a little bit of support, and it's just, yeah, I can see why you've gone for that 1.6800 handle. Richard, I think that's spot on. You know, you might want to say, okay, the support levels coming in here a little bit higher, 1.6807, but given the fact you've got that big round number, the 1.68 there, I think any retracement to that 1.68 level would be suitable for shorting. And then looking at taking profit down here, just, you know, 80, 90 pips just down below at the ADR lows for the day. Richard, I'd agree with that. Yeah, I think you've chosen the right area to look to short from. Yeah. Sajid, hi. What's your idea about central bank policy divergence? Do you think it's better to target long-term trades, 200 to 500 pips presently? Generally, I prefer long-term swing positions. Yeah, Sajid, long-term trades are, I think they're good. Yeah, you obviously can avoid some of the intraday stress and messing around with your positions. So there's definitely some advantages to the central bank policy divergence. The only difficulty we're seeing at the moment is that with interest rates, you know, with interest rates all sort of being very low equally, it makes its central bank policy divergence is harder to come by at the moment, because a lot of the central bank's policies are very similar. But generally speaking, Sajid, I think it's an excellent idea. Obviously, you know, one area for you, I think, Sajid, would be looking at the Australian dollar and the New Zealand dollar economies. They're set to be the two of the quickest economies to come out of the COVID-19 crisis. New Zealand only had 19 COVID-19 deaths, thankfully for them, which is good. And they came out of lockdown 27th of April. So they're getting back to business. So you would expect Australian dollar and New Zealand dollar to be supported going forward. So what I'd look at for you, Sajid, is I'd look at the Aussie and the New Zealand dollar and dig into a little bit of research and find out that, you know, the best central banks to pair those up against. You're looking, you know, a really weak central bank against the Aussie and the Swiss, and the Aussie and the RBNZ would be good, given the fact that the Australia and New Zealand are looking well placed to come out of the COVID-19 crisis. Oh, Lance, may I ask that you post the question on the questions board as you begin to answer it, so that we may continue to reference the question while you're answering it. Often questions contain a lot of info, and for me, I'd like to be able to have a second or third read of it so that I know exactly what you're answering. Thanks. Oh yeah, no, I don't know how to post it on the questions board. Yeah, that's a good point, Lance. Yeah, and let me think about that. I'll try to remember to bring that up to the guys in the chat. I don't know if there's a technical way of putting the questions onto the board, so I'm not sure about that. Maybe post the questions into the chat, maybe the long questions. If I see a long question, I'll try that, Lance. Horatio, last week on one of the days the market was risk off, I asked a question on the terminal saying the weakness in the equity market wasn't being translated to the currency market. And Anna pointed out that I was in the wrong, that the markets did match each other and the current risk sentiment at the time. This is something I've been struggling with. After further review of my scenario, I realized I'd missed the moves and entered the market when the moves were retracing. And that's what led me to believe at the time the currency market wasn't matching the rest of the market. This seems to happen to me often. I live in the Eastern time zone, US, wake up around 5 in the morning, middle of the London session, if I'm not mistaken. Yeah, that's about 11 o'clock our time. Try to review the news, UK time rather, and try to review the news terminal. What do I have to fix to make sure I'm entering at better favorable levels in relation to the ever-changing risk sentiment, and make sure I don't miss this moves and enter after they've already made their run? Okay, Horatio. So I think the key thing for you is to realize the difference between a retracement and a sentiment shift. That's what I think it is. So, for instance, let's say, you're looking, let's say these markets now, Horatio, okay? And that's a long question, so Lance, let's see if this works, trying to post that in there. Okay, so there. Right, let's have a look. So in this market, we're currently risk on. Okay, so we have equity markets moving higher. Now, bond yields are currently moving lower, so that's skewing the picture a little bit. But we have gold prices moving higher, crude, Brent and WTI moving higher, copper prices moving higher. Okay, we've got the volatility index moving lower. So broadly, that's a risk-on perspective. Now, the thing for you, Horatio, is, say, for example, the equity markets start pulling back. And these pullbacks, you know, Euro stocks goes to 0.10%, DAX 0.20%, you know, Dow futures down to 0.85%. And then you'll see a retracement in the currency space. The question I think you need to ask is, what is the reason for that retracement? So has price moved for a reason? And if there's no reason, then you could consider that just being a pullback, okay? Now, if there was a sudden reason, so, you know, Donald Trump says we are definitely putting tariffs on China, and then you saw equity markets losing value, you can know, okay, this isn't a pullback, this is a change in sentiment. So one of the difficulties at first, Horatio, is it's easy to recognize when a market is risk on, and it's easy to recognize when a market is risk off. It's harder to see when is a risk on market just pulling back, when is a risk on market changing. So I think that's what your struggle is. So what I would focus on is, do your intermarket analysis. So in this scenario, look, you've got it, we've done it, everything is risk on. Then if you see, then you've got your currency pair. So let's just say you decided to trade Aussie US dollar long, okay? And then price moves back here, and you've seen there's a little down tick in equities, a little down tick in yields, and you've got this little pullback. Now, if there's nothing changed, there's no reason for that pullback, and the positive sentiment still remains. So you could know, I'm going to take this trade. So look at think of the reason. You know, sometimes the markets will move, and we'll suddenly say, oh, you know, dollar moves 50 points up high. Can't see any reason for the move. So part of that is what we're doing. We're saying, okay, there's been a shift in the market, but there's no reason for it. So what I would do, Horatio, is I'd focus on the reason. I hope that helps a little bit, Horatio. Judah, yeah, we are posting on Forex Live, and sometimes it's been my voice and Arno's picture. Yeah, it's yeah, it's just to do with the time that I'm posting. I want to get on. The backstory there, Tudor, is that because I work for forexlive.com, I know how to do all the posts. So it makes sense for me to do the posts, but we're using Arno's face, so it doesn't get confusing between us. That it's, you know, that it's obvious it's Forex Source rather than something that I'm doing. So we're going to try and work that out, Tudor, going forward. Yeah, it's funny. Hi, Ramu. Hello, Giles. What's your trigger indicator candle pattern to execute the trade if the price reaches buy sell zone? Oh yeah, it's the trigger is just reaching the zone. So for instance, in this euro pound trade, as soon as price came into this level, I just entered it short, Ramu. So I'm in this euro pound trade here, just entered it short. There was no trigger, it was just a retracement, because the trigger was the fundamental news flow. The fact we got this diverging view between the ECB and the Bank of England, where the ECB struggling with German's court, you see, with the German court decision. So that's negative euro and some pound positive. So Remu, it's just the return to that resistance level is enough. Yeah, Michelle, will I share my opinion of holding trades over weekend? When is it worth it and when it's better to avoid it? Well, I was reading some interesting research that Friday has been the worst day in the stock market this year, alongside Monday. So Fridays and Mondays have been two of the worst days because obviously, you know, over the weekend there's been more coronavirus outbreak stories, more gloom and doom, and so we've seen a lot of risk being sold into the weekend because people don't want to hold risk on trades going into the weekend. So it's better to avoid it when there's lots of market uncertainty. So say for instance, that Europe is having an election for the next, you know, there's going to be an election in Germany and it's controversial which party wins or loses. And the election is going to be announced on the Saturday. Obviously, you wouldn't want to be holding the euro into the weekend because the chances of price gapping a couple of 100 points are very large. So when there's large unpredicted events, try to avoid holding into the weekend. The general rule of thumb is because unexpected events can and do occur, it's probably better to avoid holding into the weekend altogether. Okay, because you don't know what's going to happen over the weekend, and the problem is you can't alter that, you can't change that trade when you're in the weekend. You just got to wait for the open, and then you could wait for a painful gap. So Michelle, what I would say is my general opinion is I will occasionally hold trades over the weekend, but the risk you have with holding trades over the weekend is you get an unexpected event. Now, I don't trade with leverage, so it's much more relaxed for me. But it's certainly, if you're trading with any amount of leverage, be very cautious about trading into the weekend. And generally between big political events, anything around this coronavirus, you don't want to hold anything into the weekend, especially with Donald Trump. Is he about to declare tariffs on China, you know, on Saturday morning? It's quite possible. So current market environment's not worth holding into the weekend. If things are generally calm and stable, then, you know, there isn't necessarily a problem with it, but you're always running that risk. Oh, Lance, thank you. Just to add to the question appears on the Q&A board as soon as you're finished answering it. Lance, that's great. I can easily solve that. What I'll do, I'll just put answer live as soon as I've done it, and then it will appear. Yeah, okay, Lance. Hopefully that'll work. Yeah. Horatio, two currencies that have been beating me down recently have been the pound and CAD. I'm trying to learn to accept that the market throws me instead of fighting it, but I don't understand the strength on both currencies, especially the CAD recently. I understand oil prices have gone up from that crazy minus $40 barrels, but up until this week, it's been trading below $20 a barrel. How is this so supportive of the CAD, considering the Canadian oil market can't survive at these low prices? Their economy is getting hit hard, but it seems like they would really feel it especially harder since it's so export dependent. Seems to me like the CAD will be getting crushed, yet seems to be holding its ground. Yeah, I understand, Horatio. It's very, very sensitive to current prices, isn't it? So let's just take a look at US dollar CAD. So, you know, let's just zoom out. So, okay, you know, here we are seeing weakness, aren't we, in the CAD? This sudden US dollar strength. You got the US dollar CAD kind of range bound. If market goes risk off again, you expect more upside in the US dollar CAD. We've got that overhead resistance zone just containing prices. Yeah, you know, Harish, I'll think about that. I'm going to think about the resilience of CAD. I haven't got anything insightful to say over it, other than what you've already said yourself. Like, you're recognizing that as oil prices moving up higher, you know, that's been quite a good bull run, has been supportive of CAD. In terms of like its wider value, I guess a lot of currencies are being beat up at the moment, and a lot of currencies are set to struggle with COVID-19. So I can't say anything more intelligent than that, Horatio. With the pound, is it pound strength you've been struggling with? Because the pound is just still under the cosh with the EU-UK trade deal, really. I mean, you can see that, you know, I wouldn't say there's any particular surprise in the pound, really. You just see the pound is just sort of quite narrow in this little range, not able to break above these recent highs. EU-UK trade deal still to be organized, so pretty negative and bleak for the pound. So I'd say with the, you know, the pound, that's not a particular surprise of weakness or strength. It's just a kind of a mid-range, still to be decided. Okay, that's good. Okay, I'm just clicking through some of these. Can you share your TradingView template if that's the platform for your summary page? Yeah, no, I'm not sure how we share the template. Let's see. Everyone with a link can share and view a copy. Make a copy. Is this how you do it? And no, I'm not sure how we share the template. I can show you the template that we use. So this is the template we use for the major currency pairs. So this maybe want to speak to support Sam. I'm not up to speed with how we share this template. This is our dominant currency sentiment pairs. Then this is our future equity market pages and the VIX. This is our commodity page: gold, silver, platinum, WTI, Brent crude, and copper. And this is our yield page. Oh, you're welcome, Hiroshi. Yeah. Oh, yeah. No, sorry, Sam. Sam, if I knew how to send you it, I would. So I'm sorry, I can't do that. If you just contact support, Sam, someone will have a template almost certainly. I'll check the question and answer panel. Sometimes someone else will have a. Yeah, thanks. That's great, Sam. Sorry about that. That's okay. I'm just going to check the questions. Yeah, okay, guys, that's the run of the day. Just a reminder before we close off, initial jobless claims worth looking at later, because that could skew the risk perspective. And we got those initial jobless claims coming out 1:30, so just around an hour's time. 3 million expected, 9 million max, 1.5 million min. That's the next kind of main risk. Oh, Sergey, yeah, I did a video yesterday on fake outs. You can use that on any time frame, Sergey, but it works best on like your larger time frames. it can be really, especially your daily chart, that can be really helpful. If you're ever wanting to see, Sergey, if a level is going to hold or not, look at the daily close, because the daily close of the candle is key. If you get a close above that level, that's a good key that at least you're going to get a temporary break at the very least. Okay, thank you very much, guys. It's been a pleasure as always. Thank you for your questions, and been stimulating as always. And I wish you all the very best for the afternoon session. And I will be covering the afternoon session on the videos, so I will be at the back end picking up any questions that you have. Yeah, thank you, Rolando. Take care now, guys. Yeah, and you, James. Thanks, guys. Goodbye.